Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com, and you are tuned into a special presentation entitled, Would You Have the Nerve? And as you can see from that picture, would you have the nerve to try and catch a falling knife? And I'm going to look at a strategy that is designed to profit from pullbacks. It is a mean reversion trading system. First and foremost, we'll get the disclaimer out of the way. This presentation is for informational purposes only and should not be construed as investment or trading advice. Trading and investing in the financial markets involves risk. Past performance does not guarantee future results. And of course, you and you alone are responsible for your own trading and investing decisions. So a little bit about myself. I'm a chartered market technician with the CMT Association. 20 years experience as an analyst, a trader, and an educator. I was schooled in classical technical analysis, and that would be with the chart patterns and the momentum oscillators and the breakouts and the trends. And in 2016, I crossed over to the dark side. And by that I mean I started looking into quantitatively driven strategies, quantitative analysis, where I would backtest a trading system and then apply those results to try and find a more suitable system other than just looking at chart patterns or breakouts. So with that, I have developed this mean reversion trading strategy. I wrote a book back in my days as a classically trained technical analysis, but it's still built on pullbacks within an uptrend called Define the Trend and Trade the Trend. And trading that trend is basically looking for pullbacks that are playable. And of course, you know, I am the Senior Technical Analyst at StockCharts.com. So the key topics that we are going to discuss today will be, first, I will define the mean reversion trading system with some charts, of course. I'm going to go over the components of a mean reversion system. It's surprisingly simple. You need an entry and you need an exit and you need a market regime. We're going to look at the importance of market timing, which is the market regime, bull markets and bear markets. I'm going to go over trailing stops, profit targets, and chandeliers. And some of you might already guess that that is the Chandelier Exit, which I have found to be very good as part of a mean reversion strategy or system. And I'm going to show you a classic method to reduce your drawdowns. Mean reversion systems already typically have pretty low drawdowns, but we can reduce those even further. And then I'm going to show you how we can get to some double-digit annual returns, adding in a little bit of leverage. So let's look at a mean reversion system and figure out what exactly we are talking about here. But before we do that, why would we want to backtest? You've heard people say, yeah, I've never seen a bad backtest. Well, I don't know what backtest they're looking at when they say that, but I've done lots of backtesting and I've seen plenty of bad results. And I've seen plenty of systems that I wouldn't want to trade or refine. And we all do hindsight analysis or historical analysis where we go back and we see what worked in the past and we learn from that and we try to apply it from the future. And that's the whole reason that I backtest. And when you backtest a trading strategy, you can estimate the potential of that strategy. Is it worth pursuing? Is it worth tweaking? Or do you need to start over again? You also learn how a system works under various market conditions. How does it perform in a bear market? How does it perform in a bull market? How does it perform in a trading range? And how does it perform when you have sharp declines? So all these things need to be taken under consideration when you're developing a system to trade. It also helps you better understand your indicators and how they work. You can design a system, you can look at all the trades with the arrows and see what the indicator looked like at the time of the entry and the time of the exit, and that will help you better understand how these work. Second, and finally, it can help you set expectations for returns and drawdowns. So, we need to have a bit of a roadmap. Is our system going to be expected to earn 15% per year but have 30% drawdowns? Is it going to be 7% per year with 6% drawdowns? We need to have an understanding of that so we know when something is not working and when it is working. And finally, when you backtest your ideas, it opens your eyes to different possibilities. And that's very important that we keep an open mind when we are analyzing the stock market or stocks. We need to keep an open mind because anything is possible. So what exactly is mean reversion trading? Well, as you can see by the sign here, there's the dip and there's the road, and we are buying when we get that dip and looking for the bounce. But we're not just buying the dip. We're buying the dip within a bigger uptrend. That is very important to keep in mind. There needs to be a bigger uptrend in play because you are betting on a reversion back to that bigger uptrend. So here I've got a chart of SPY, and this is a Roth regression channel here, the light green lines on the outside. The middle line, which you can't see, is a linear regression, which is the line of best fit for the closing prices going from the mid-March start till the end there in December. And this linear regression is clearly sloping up. I've highlighted it in a thicker green line with an arrow. And so that is the big trend. All right, and that linear regression kind of acts as the mean. All right, now I'm just using this as an example. Okay, we're not going to look at the deviation from this linear regression in our system. I'm just showing you the idea here, the concept of a mean reversion system. So basically what happens is you get a pullback, a dip, and you're looking for a reversion back to that mean. And sometimes you go over. And then you get another dip here like we did in June. All right, and then we get another reversion to the mean and we overshoot to the upside. And then we kind of fiddle around and get another dip and a bounce and a dip and a bounce. So we're looking for these dips to capitalize on the subsequent bounces. So what are the advantages of a mean reversion trading system? Well, first, there is a clear exit strategy. I always sign off my commentary with plan your trade and trade your plan. And when you set a strategy or a system in place, you have a clearly defined entry and you have a clearly defined exit. And you trade according to those rules that you've developed. And with a mean reversion system, we have a clearly defined exit strategy. Mean reversion systems typically have a high win rate, greater than 60%. And the shorter the mean reversion time, like if you're trading an RSI 2 strategy, the higher your win rate's going to be, but also your gains are going to be quite small. The total gains are greater than the total losses, and that's what makes the system profitable. And typically from these mean reversion systems, we can get a profit factor greater than 4. That is the total gains divided by the total dollar losses. And finally, we have good risk-adjusted returns because we're not in the market all the time. That time that you're not in the market means you're not exposed to risk, so you will have a higher risk-adjusted return than if you were in the market the whole time. Now, of course, there are disadvantages to a mean reversion system. Every system has its advantages and disadvantages. One of the disadvantages is there's really no stop loss. All right, you don't put a stop underneath your trade and exit if it becomes a loss. And what this means is often you have a loss before you have a profit. And so this makes it a counterintuitive strategy, as I'll show in a minute. The other side that people find a disadvantage is you're not fully invested. The exposure is typically less than 50%. So less than 50% of the time you actually have a position in the market. And as I said, it is counterintuitive. it really takes some discipline to buy that dip. So there's a dilemma. And this is the dilemma that I've been facing because I was schooled in classical technical analysis, breakouts, MACD crossovers, you name it. And so you've got the classical technical analyst on one side whispering things in your ear, and on the other side, you have the quantitatively driven strategy telling you something else, and it can create confusion. Now, I'm not going to say who's the devil and who's the angel, because you can make money using both strategies, but I am starting to favor the quantitatively driven strategies. So here's an illustration of the dilemma, or what happens to the classically trained technical analysis. And this has happened to me, and it still happens to me because I still do analysis based on, what I see as maybe a distribution pattern or a support bounce. And here we can see that we have, a low, a clear support zone there, and we get a little gap off support. Hey, that looks like a low risk opportunity. We should buy this gap because we're going to bounce and this trend is going to continue. So what do? We buy. Well, the gap immediately fails and we break support. So we have to reassess what's going on. So what's happening? Well, look, there are two highs in the same area, and clearly a lot of support here and a break. So we have a double top. We have a bearish reversal. So this trend is now down. And what happens? Boom, we have a gap, a bear trap, and one of the biggest rallies in years over that 5-week period there. So you sprung the bear trap. So this can be frustrating. All right, now if you're the mean reversion trader, you probably would have been active here, all right, before the support test, and you would have held down here. Totally counterintuitive. All right, but you probably would have hit an exit way up here somewhere. We'll go over that in detail, how the strategy might have worked. But, here's the mean, all right, and we're reverting. We're dipping in May and reverting. We're dipping in June and reverting. And we're dipping here in September. And a big reversion back to the mean. So it brings me to a great quote from my friend Cesar Alvarez, who's helped me a lot with trading systems and coding them and testing them. And he's a mean reversion specialist. And basically, he had this chart and it says it looks too ugly to buy. And this is an actual trade that Cesar put on. And it can be really hard to pull the trigger because the charts often look ugly. And I'd recommend if you get a chance, you go to Cesar's website there. He's got a blog where he posts his ideas on systems, and he's always a good read. All right, now we're going to look at some entries, some exits, and some indicators. And basically, these are the components of a mean reversion system. So the first thing, of course, that you need is an entry signal after a price decline. All right, and that can be with a percentage decline or a ATR multiple decline, or you can use a momentum oscillator to look for some sort of oversold reading. And that can be with RSI moving below 30, or the stochastic oscillator moving below 20, or the commodity channel index moving below minus 100. Next, you need an exit signal. All right, and this is, of course, very important because you need to know your way out once you get in. And this can be a profit target. So it could be a percentage move higher or an ATR multiple higher above your buy price. You could implement a trailing stop or a combination. And I'm going to show some different testing using all three and show you why I picked one over the other. And the third thing that you need is broad market timing. Now keep in mind, this is for a stock-related system, equities. And so it's important, if you're going to trade on the long side, you need to be in a bull market. You don't want to be trading the long side when we're in a bear market, because that is fighting against the tide. You're swimming against the tide. And so that's why I use the S&P 500 for the long-term trend analysis, or basically to decide if we're in a bull market or a bear market. All right, so here is a basic mean reversion entry strategy you can see here. And you have two possibilities when you're using an oversold oscillator. I'm using RSI 5 period, you can see there. And this chart is for SPY. And basically, you can buy when RSI goes below 30. So that is literally catching the falling knife. The knife is still pointing down when you go below 30 here. Now, I personally like to look for some sort of an upturn, and I like for RSI to move back above 30 to trigger my signals. And so you can see there are 3 signals on this chart. One there in the middle part of November. We had another one there in the early part of February, and we had another one at the end of March. And so you can see that these are ugly looking charts, because look at this decline and you would be getting in. And the same thing here. There's another decline and you would be getting in. So that's why it can be counterintuitive to trade a mean reversion system. But anyhow, this is how an entry usually looks. All right, so what are the exit possibilities? Well, the first one is going to be a profit target exit. And in this example, I'm using a multiple of the average true range. I'm using 2 times the average true range. So you can see there's the average true range on the date of entry in November, and it was 1.33. And if I do 2 times that average true range and I add that to my buy stop, I get a target. All right, so that target is going to be the entry price plus that average true range times 2. And you can see here, it didn't work out so good in November because you would have gotten stopped out and you would have missed that big run. But you can see here in February, you would have gotten in and you would have gotten out fairly close to the high. You wouldn't have picked the exact high. And then in March, you would have gotten in here and your exit would be around 275 going forward. So that's just an example of how to use a profit target. And you can see here the ATR went up as volatility increased. So our profit target was like $6.16 above the entry. All right, and the ATR was even higher in that late March entry. And so that pushed the profit target up because it is a multiple of the ATR. The other strategy you can use is a trailing stop. Now, you saw before that November signal. Well, if you use a trailing stop, that November signal, when you had a buy here, there's the green line marking the RSI buy signal. This is a trailing stop that is basically the previous day's close minus the previous day's average true range. And I'm using a 22 period average true range, which is around 1 month. And I'm showing this on the chart using a Keltner channel. And what I've done here is you can see this Keltner channel, the settings there are 1, 1.0, 22, and 1. So the first one is for the close. All right. The second one is the ATR multiple. How many times am I going to multiply that variable by the ATR value? The third variable is the ATR setting, the parameters, 22 days. And then this last parameter I tacked on is moving the indicator 1 period forward. And what does that do? Well, here you can see the last period. I've got the close here, and I've got the Keltner channel, and it's moved 1 period forward. All right, so that is the previous day's Keltner channel readings. And if you're doing a trailing stop, you can see what your stop is going to be for the next day, basically. So this is what it is here. So you can see here that if you had gotten in on the mean reversion signal in November there on the lower left, you can see that the stop was not triggered until late January. And that was clearly the trade of the year because you closed below that lower Keltner line on January 29th. And I just added a histogram, and this histogram just shows you the difference between the closing price and the previous day's value of the lower Keltner line. And you can see it turned negative. So that means the price closed below the previous day's lower Keltner line. So this is a trailing stop. And yeah, it worked beautiful on this trade, but it doesn't work beautiful all the time. And we'll see that with some testing, because keep in mind, you can't build a system based on one perfect trade. The system has to be based on a long time period. It should include a bear market, and it should include different market environments. But in the future, if you want to develop this ATR trailing stop, here's the little chart trick you can use with the Keltner channel. So here's the same trailing stop that I just showed you. All right, and what we're going to do here is there's the big winning trade. All right, huge winner. And then you can see we got an entry there in February. We would have had an exit the very next day, whipsawed. We had another entry a couple days later, and we would have gotten an exit there in March 19th. So that would have been a winning trade. And we would have had another whipsaw here. So you can see if you look at the trades, this is just over a short period. All right, we can't judge a system based on this short of a period or so few signals. But you can see there are quite a few whipsaws when you use a trailing stop. Now let's look at the Chandelier Exit. All right, and the reason I like this is because I think it is an indicator that works as both a profit target and a trailing stop. And you say, well, how can that be? Well, bear with me, because typically when you enter a mean reversion trade, when RSI is coming out of an oversold condition, the Chandelier Exit is above the entry price. So that means prices have to move higher in order to even start thinking about some sort of an exit. And also, the Chandelier Exit dynamically adjusts as prices change. And so for this reason, you do not need a risk of ruin stop loss. It's not a trailing stop, but if prices do continue lower, the Chandelier Exit is going to move lower, and your exit is also going to move lower. So eventually you'll get a little bounce and you're going to get an exit signal. So let's look in detail at how this Chandelier Exit works. So I've got a basic Chandelier Exit. This is 22 periods with 2 periods for the ATR multiple. And so basically, and I'm going to go into detail on how the Chandelier is actually calculated, but for now, here is how Chandelier is typically thought of. It's typically thought of as a trailing stop. And yet it works beautiful as a trailing stop when you have a nice trend. And how often do we have a nice trend? I think 2017 in the beginning or January 2018 was exceptional as far as the strength of these short-term moves that we had. But you can see here, if you'd gotten in late August, on a closing basis, you did not close below that Chandelier Exit until early November or even mid-November. So you had a really nice run there. And you can see here we had a 34-day run above the Chandelier Exit. This previous run was 54 days. So if the market continues to move higher, man, trailing stops, they work great. But as we know, the market doesn't act the same way all the time. You have to be ready for different environments, different looks. So let's see how the Chandelier Exit actually works to understand what it is telling us, because it is very important that if you're using an indicator to trade, you fully understand how it is calculated and how it works. If you don't understand that, you don't really understand how it's working or what it's telling you. All right, so this is the Chandelier Exit. The blue line is the 22-day price channel. And that basically measures the 22-day high and the 22-day low. The Chandelier Exit is based on that 22-day high. What it does is it takes the ATR, and I'm using a 22-period ATR, and it multiplies that ATR value times 2. And you can see here the ATR is 4.579, and the 22-day high up here is 279.22. So it multiplies that ATR value by 2 and subtracts that sum from the 22-day high, and that's where you get your Chandelier Exit. So now that we understand how it is calculated, let's see how it works in action. So there are 3 periods that I'm going to highlight here on this chart to show you the workings of the Chandelier Exit. The first period, you can see that blue line is the 22-day high, all right, and it is moving higher, all right, and this is actually the previous day's 22-day high. You can see the settings are channel 22 up there on the upper left, all right. So there's the high, and there's the 22-day high stayed flat here. So as the 22-day high rose in January, the Chandelier Exit rose, and that makes sense. All right. Then we had the 22-day high flat, but the Chandelier Exit fell. And why is that? Well, that is because the ATR rose. Volatility turned up. So when volatility turned up, the value of the ATR moved higher. And since the Chandelier Exit is 2 ATR values below the 22-day high, this distance grew because the ATR value was rising. And so that's why the Chandelier Exit fell. In the third part, you can see we had a relatively elevated ATR value down below, and the 22-day high fell. And hence the Chandelier Exit fell. And so you can see if you'd entered a mean reversion trade here in early February and used the Chandelier Exit, then you would have to wait until prices moved down, and then until the Chandelier Exit moved down and prices moved above the Chandelier Exit to get your exit set up. So that's why it's kind of acting as a profit target, because you're buying when prices are well below the Chandelier Exit. So you got a profit target up here. And then as prices move and decline or advance, the Chandelier Exit dynamically adjusts. And so that's why it kind of becomes a trailing exit or trailing stop, if you will. So here are some trades based on the Chandelier Exit. And the green lines again show the RSI entry that I showed you at the beginning. And so we got our whipsaw here in November. And then we got an entry there in early February. And we would have had an exit signal there in March. Now I tightened this chandelier, by the way, to 22,1. So I'm only using one ATR value, 22 period ATR, one value below the 22-day high. And I prefer a bit tighter of a stop loss because it does help with the drawdowns. So you can see here we moved above, and so then it was possible to have an exit signal. And the exit signal triggers when you close below the Chandelier Exit. So here we moved above it, and then we closed below. We had a cross from one close to the other below the Chandelier Exit. So that's your exit signal, and you would have had about a 2.7% gain on that trade. Again, we had a signal in late March, and then you can see we bounced, moved above the Chandelier Exit, and then 2 days later or 1 day later closed below it. And so that triggered the exit, and you would have had about a 1% gain using this strategy. You buy when RSI moves above 30, you wait for price to move above the Chandelier Exit, and then you exit when you close below the Chandelier Exit. All right, so now let's look at some benchmarks with which we're going to measure the results of the system. We'll review the system and we'll see if market timing helps or hurts results. So here is the testing period that I am using here, and it goes from the beginning of 2007 all the way until the third quarter of 2018. And you can see here that this includes a bear market when you had a decline in excess of 50%. That would have been tough to sit through. We also have a period when the market declined sharply in May there. So you had the flash crash basically. We had the European sovereign debt crisis. So we had two sharp declines and then some really volatile periods after that. And then we had the mini bear market, if you will, where we had around a 14% decline from the summer of 2015 until early 2016. But overall, you can see different market environments over this 11-year period or so. So what about buy and hold versus simple timing? Well, if you just bought and hold SPY on this period, you would have gotten 7.82% per year. If you had bought a 5-day SMA crossing above a 200-day and sold the 5-day crossing below the 200-day, you would have gotten a 6.5% return. So lower return here. But you can see that your exposure would have been less. And that is because you would have been out during the bear market. You would have been 75% exposed. And you can also see that your drawdown was much lower. Instead of a 55% drawdown, you have a 20% drawdown. And that's the main reason we use market timing, is to lower those drawdowns. So here's the mean reversion system that we're using. This is just a rehash. It's buy when RSI 5 crosses above 30, which is the green vertical lines, and sell when you close below the Chandelier 22.1, which is the red. These are the red vertical lines. The ground rules for the system are pretty simple. It's only long and only long with market timing. And I'll show you the market timing in a minute. But we're not looking at short positions here. All right, just started out with a $100,000 portfolio, $5 commissions. There's the testing period we talked about already. I'm using total return data for all of these ETFs, so that means the dividends are included. So when I look at QQQ and MDY and IJR, those dividends are included in the return. The signals are based on the close, and the buy and sell entries are based on the next open. All right, I'm just keeping it as simple as possible. I'm using Amy Broker software to do this backtesting and premium data from Norgate. So here's a basic mean reversion system with market timing. And again, we're just using SPY as our base to develop this system. And then I'm going to broaden it out and include IJR and QQQ and MDY. And then we'll look at those leveraged ETFs. And you'll be amazed at the effect that the portfolio has on drawdowns and returns. So if we look at SPX, we have the S&P 500 for timing. So we're only buying when the S&P 500 is in a bull market. The 5-day moving average is above the 200-day moving average. And so if we use the mean reversion system on SPY, we get a compound annual return of 7.19%. Not great, but you can see that exposure is 34%, so it's around a third. But here's the thing, the maximum drawdown is 11.54%, and that is a very low drawdown. So you're having a lot less headache because of this low drawdown. You can see the win percent is 74%. Again, with mean reversion systems, you get a high win percent, and the average gain is greater than the average loss, 2.62% to 1.5%. So what happens if we just say, nah, I don't care what the broad market is doing. I'm going to trade this mean reversion system, and you can see the results are going to be worse. You have a 4.35% annual return in place of 7.19%. Your exposure goes up, and look at that. You have a maximum drawdown, so there's lower return, and you have a maximum drawdown of 50%. And I don't know anybody that can trade a system that has a 50% drawdown. I know I couldn't. And you can see that the average loss is greater than the average gain. So you really need to include broad market timing. All right, now we're going to look at some sensitivity tests, and I'm going to test the 3 exits that I proposed at the beginning: the profit target, the trailing stop, and the chandelier exit. Now, I'm not going to look at every single innuendo or detail of this table, but I'm going to just show you what I think are 2 important things, and that is the compound annual return relative to the maximum drawdown. There's the compound annual return, and there's the maximum drawdown. And what we want to see is we want to see a compound annual return that gets close to that maximum drawdown, and ideally a compound annual return that's greater than the maximum drawdown, but that is really hard to do. So first we're going to test the profit target sensitivity, and I'm using an ATR multiple for the profit target of ATR 22. So we start at 0.5 times the ATR above the buy price, and then we go in 25 quarter point increments, 0.75, 1, all the way to 2.5. And what we can see here is that the CAR relative to the maximum drawdown, the compound annual return relative to the maximum drawdown, only gets above 0.5 once, and then it gets to around 10%, where your return is like 10% of your drawdown. You can see 5% return for a 55% drawdown. So that is no good. Now you might notice that the win rate there is almost 100%, and actually it is 100%, because the only losing trade is the current trade, because prices always come back to hit your profit target. I mean, unless we have a multi-decade downtrend, the prices won't come back to hit your profit target. But here's an example of a trade that you really, couldn't trade yourself. But you can see here that, you would have had an entry here in 2015 around 199.07, and your profit target would have been 2 times the ATR, 3.4 above, which had been around 202.5. But you can see you didn't get above that level. And in the meantime, you went down here and you're an idiot, and you went back up and you're like, okay, I'm not so bad after all, I'm a genius. And then you're an idiot again when the price goes down, and then boom, you finally hit your profit target and you say, I knew it all along, I'm a genius. Well, come on, we really can't run a system that takes such a small profit and goes through these big drawdowns and holds a trade for almost a year. So the next sensitivity I'm going to test is the trailing stop. And again, we're using the average true range, the ATR. And you can see that the ATR is 22 periods. Again, I start at 0.50. So 0.50 below the previous close times the ATR. So it'd be the previous close minus the ATR times a half. And then I go up in steps of a quarter point all the way to 2.5. And again, we can see that the win percent is low. You can see that it only gets up to 69% when you get to a high trailing stop, a wider trailing stop, but the maximum drawdowns increase. And then you can see the CAR relative to the MDD, the compound annual return relative to the maximum drawdown, never gets above 0.5. So this is really not a feasible trading system either, because your returns do not justify your drawdown. So the other one we're going to look at is the chandelier exit. And again, I'm going to test it in steps of a quarter point. So we're using 22 periods for the ATR value. And the chandelier is going to be a half ATR value below the 22-day high, 3/4 of the ATR value, 1 ATR value below, and so on as we go down. And so you can see here that the CAR to the MDD ratio is the highest of what we've seen. So it gets above a half, and it gets all the way to 0.71 here when we have a 22-period ATR and a 2.25 point chandelier. You can also see that the compound annual return is relatively stable, going from around 5 to 7%. And then we look at the win percent, and it's in the upper 60s to the low to, here we have an 80% win rate. You can see the tighter the chandelier, the higher the win rate there. So it seems like the chandelier is something that I want to work with, and that's why I picked it for my system. So now let's look at this system, and we're going to expand it to some other ETFs and show you how to get some free lunch. So basically, we're going to add QQQ, IJR, and MDY to the mix. So we're going to use 5-day RSI for QQQ. So when it moves above 30 for QQQ, we get a buy signal. And we're going to use the Chandelier Exit 22-1 for the exit on QQQ. Each one has its own individual signals based on those indicators. All right, so if we had a 4 ETF portfolio, first we'll look at them individually. And you can see here that the compound annual return for SBY was 7.19%. And we got double-digit returns from 2. You can see that the compound annual return for QQQ got above 10%, and it also did for IJR. So the returns are increasing. That's good. We can also see that the profit factor is very high. And the profit factor is the total dollar profit from the winners divided by the total dollar profit, dollar loss from the losers. And you can see it's above 5. And that's kind of like your ex-ante reward to risk ratio. So this is a very good profit factor that we're getting here. So those numbers look all in good. And you can see the CAR relative to the maximum drawdown is not too bad either. And we almost got to an even level there at 0.92 for IJR, which means our compound annual return was almost equal to our drawdown. But what happens if we treat these as one portfolio and instead we trade all 4 at one time? Well, there are the individual numbers again that you can see here. And there is the compound annual return if you have 4 equal weighted positions for all 4. And you can see that last line shows all of the numbers that we're interested in. And look at that. The compound annual return is greater than the maximum drawdown. So you had a 9.5% annual return and you had an 8.8% maximum drawdown. That is pretty good. And that is the power of the portfolio. It's diversification. It is reducing your risk. It is bringing your maximum drawdown down. Of course, it brings your compound annual return down, but not so far down that it goes below your maximum drawdown. And the profit factor was above 5 for the portfolio approach. So this is a very interesting finding. So let's look at the equity curve. And I should note that I've been running this system since the end of 2016, December 2016. I advocated the portfolio approach. So that was kind of like the out of sample, and it's been running in sample since December 2016. So a little over a year, and the returns have been about the same, 9.5%. So if we look at the equity curve here, we can see that the 4 ETF portfolio was out during the bear market because we're using market timing. And then you can see the growth of the portfolio over time. It continues to grow, and it's a pretty good equity curve. And we're out during that little bear period in 2015, early 2016. So here's buy and hold for SPY. And you can see that you would have gone down, a big drawdown there, but you went flat during the buy and hold period. And that's what during the, when you would have been out using market timing. And then the market rallied, of course. It rallied, but it didn't rally enough to overtake this 4 ETF portfolio. And then when we look at the drawdowns here, we had a maximum drawdown in 2007. And the other drawdowns were in that 7 to 8% area. And you had 1, 2, 3, 4, 5 other drawdowns in the 7 to 8% area. But that gives us a good idea of what we can expect if we trade this 4 ETF portfolio using equal weight positions. We can expect a 9 to 10% annual return. It's not guaranteed. Nothing in the future is guaranteed. And we can expect drawdowns in the 7 to 8% area for the maximum. So here's a distribution of the trades, and we can see that the bulk of the trades are in the 0 to 5% area here. 135 of 215 winning trades. We can see we had 27 trades that were profitable in the 5 to 10% area, and 4 were greater than 15%. And then on the losers, we had 46 in the 0 to minus 5% down, and 3 between a 5 and a 10% loss. So you can see only 3 trades where you had a loss between 5 and 10%. That's not too bad. So you had 166 winners, 77%, 49 losers, 23%. That's not too bad. All right, now we're going to look at adding some leverage to the mix, and we are going to do that with 3 2x leveraged ETFs. And the backtest period is the same as I've been using all along. It goes from January 1st, 2007 until March 31st, 2018. And I'm not interested in 3 and 4 times leveraged ETFs. First of all, you can't backtest them that long. And second of all, they tend to be more thinly traded. And third, I'm just not interested in that much leverage. 2 times is enough for me. So the 3 ETFs, the Ultra S&P 500 SSO, the Ultra QQQ QLD, and in place of the S&P Small Cap 600 iShares, I'm using the Ultra Russell 2000 ETF because the small cap ETF that's leveraged for the S&P 600 is thinly traded, so that's why I chose UWM. The mid-cap leveraged ETF is too thinly traded, and so I opted not to use it and just use a 3 ETF portfolio. But what you can see here is that you are getting higher returns, so we get a compound annual return getting above 20% for QLD and 20% for UWM. But of course, that comes at the price of higher drawdowns from 25 to 32%. And this is just the way the world works. If you want higher returns, usually you're going to have higher drawdowns. And you can see our CAR relative to the MDD is around a half to a third, no big deal. Exposure running around 37 to 39%, and the profit factor from 3 to 5 roughly. So what happens if we do a portfolio approach instead? And here I've got a 3 ETF portfolio that I'm going to test. And I've got the results on the bottom. And it's an equal weight portfolio. And you get a signal from one, you take it. You get a signal from another, you take it. And sometimes you can have all 3 active, sometimes you're not. But using this portfolio approach, you can see that the compound annual return stays in double-digit territory. We have 18%. And look at the maximum drawdown. It's the lowest. So we got our return staying fairly high, and we just really took a lot off the drawdown. And as a result, you can see the CAR is 86% of the maximum drawdown. So our annual return is almost equal to the maximum drawdown. And that is the power of the portfolio. Just a little bit of diversification can really go a long way to reducing your drawdowns. And you can see that the profit factor is above 4. So this is a very good profit factor. So this is something we need to consider. Even if you're just trading something that is based on the broader market, adding some diversification with, say, small caps, mid caps, SPY, and QQQ can really help you out in your drawdowns and even out your returns. All right, so what conclusions can we draw from this whole approach and also from general system development? Well, first and foremost, I would say You need to keep it simple and avoid curve fitting. As you can see with these systems, I'm using very simple indicators, RSI 5 period. I'm using 30 for my signals. That's not a number that was pulled out of the air or curve fitted. That is a very widely used number for oversold for RSI. The chandelier, I'm using a basic chandelier. I've got basically one entry signal, one exit signal. It's a very simple system. The second thing is broad market timing is essential if you're trading stocks. As we saw from the two test results using SPY, you're going to have much bigger drawdowns if you don't ignore the bull market and the bear market. In other words, you've got to play during the bull market and you've got to ignore during the bear market. Just stay on the sidelines. You're welcome to short if you want, but usually it just helps to just preserve cash and move somewhere else and wait for the bull to return. I'd also keep in mind that the concept is more important than the details. All right. Keep in mind that the concept here is when you've got a long-term uptrend, when you're in a bull market and you get a dip, that dip is your friend. That dip is not your enemy. Sure, one of these dips is going to result in a bigger trend reversal, or it's going to last longer than we thought it was going to last. But in general, if you're looking over a long period and you look at it over 100 trades, buying the dip is a strategy that you can use and you can profit from, especially if that dip has a long-term uptrend behind it and a bull market behind it. We're looking at the trend continuing instead of reversing. Also, beware of visual signals. We see things on a chart that look good, and then we go and actually put some numbers on them and test those signals after they're quantified, and often they don't look quite as good as what we thought. As you saw from that trade that I showed you in November when the market really took off and the chandelier, the trailing stop worked perfect, and if you had used a trailing stop, you would have had a huge gain. Well, if I tested the trailing stop and it didn't work that good over that entire period. So if you curve fit one part that looks good, you're going to have the law of unintended consequences and you're going to affect other parts of the trading system. In other words, other time periods when the market wasn't trending as strong, it's not going to work it good. So the big challenge is to find a strategy that is going to work during strong trends, during trading ranges, and during something that is in between even. Also, small portfolios can reduce drawdown significantly, as we saw. Just with adding 3 in a portfolio of those leverage ETFs, we got our drawdown down quite a bit and almost equal to the compound annual return. And that's true with stocks as well. Get yourself a portfolio. That is the closest thing you can get to free lunch. And finally, mean reversion can be part of a diversification strategy. All right. Just because you don't want to put all your money in mean reversion doesn't mean you can't put a little bit of money into a mean reversion strategy. It can be 10%, 20%, the choice is yours. But there's no reason why you can't be running a couple of different strategies as part of a diversification approach. You might have a momentum strategy, you might have a trend following strategy, and you might have a multi-asset strategy, and you might have a mean reversion strategy. 4 different strategies, and one of those should be working at some point, and that gives you some pretty good diversification. So that concludes this presentation on mean reversion trading. I hope you enjoyed it. Thanks very much for tuning in and have a great day.